Analysts and investors will frequently refer to something called net working capital, or a lot of times they'll just call it working capital for short. So working capital is very simple. It's just current assets of the firm minus the current liabilities. And you might be thinking, okay, well, why are we doing this calculation? It's not required to be reported in the financial statements. This isn't mandatory. It's not required. It's not like you have to put this on the balance sheet or something like that. So why are we calculating this? Well, basically it's a measure of liquidity. So this gives us some kind of idea, some kind of estimate at how good or how well is the firm going to be able to do in terms of meeting its current obligations. Current obligations with the existing resources that it has. So basically, the current liabilities are some kind of gauge, or a gauge that we have of these obligations of the firm, and we're basically saying, okay, with the current assets, with cash, with inventory, with this accounts receivable, how liquid is this firm? Are they going to be able to meet these obligations that are going to come due in the very near future, or are they going to have to raise some kind of outside capital to do that? So that's what I mean when I say it gives us a measure of liquidity. Let's walk through a quick example. So let's take a firm that had the following. Let's see here. Let's say they had cash of 100, accounts receivable of 150, inventory of 50, property, plant, and equipment of, let's say, 250, accounts payable 75, and then let's say there's long-term debt, there's some bonds or something of 200. And so basically, just scroll down here. Basically, we want to get some kind of estimate, ballpark estimate on how liquid this firm is. And so we want to say, okay, let's calculate working capital. Let's go and get our net working capital and see what that is. Well, first thing we need to do is we need to calculate our current assets. Current assets. So what are our current assets? Right here, cash, that's a current asset. Accounts receivable is a current asset. And inventory is a current asset. Property, plant, and equipment, not a current asset. That's a non-current asset. So that doesn't factor in. That's not part of our calculation of net working capital. So what are our current assets? Our current assets are this. So what's that turn out to be? 250, 300. So current assets of 300. Now we want to say, okay, current liabilities. You need to know current liabilities because we're going to deduct those from our current assets to get our working capital. So current liabilities, accounts payable, that's a current liability. Long-term debt, not a current liability. So what do we have here? This is not going. Now if we had a current portion of long-term debt, as we talked about before, that was going to be met with cash or something, we're going to pay current. Then that could be very well be a current liability. But here we're just talking about long-term debt. It's not part of it. So what we've got is the accounts payable. That's our current liability. That's all we've got. So we've got 75. Now all we do to calculate this net working capital is just take this 300 and subtract the 75. So that's going to give us 225 is our net working capital, and that's our measure here of the liquidity of this firm.